Hello and welcome to your trader training. My name is Philip Newton and I am your coach. On this training session we're going to look at spikes, and this is essentially the magic that turns a trade opportunity from a maybe trade into a yes, I'm going to trade this today. So we're going to look at what that is, and I refer to this as a spike, and generically it's lots of things all rolled into one, but we're going to look at what that means for me and what it will mean for you. And again, it turns a possible trade into a yes, we're going to trade this. This is the final thing for me that would determine whether I'm placing a trade today or not. So we've looked at, on a previous video, again a quick overview of what a spike is, but just as a quick reminder, we're looking for a candle that has a small body and a large wick, and that is, in a nutshell, what we're looking for. Big spike, small body. So what is going on inside the day to formulate this type of pattern? If we take this one on the left, basically price is opened up here, and during the day it's sold off down to this low point, but then it's done a U-turn intraday and turned around and closed still maybe lower or possibly higher than it opened, but it's traveled quite a distance during the day. And that's what these spikes are. You know, price has opened and it's rallied, and then it's done this intraday U-turn, and that for me signifies that there's been a significant shift in supply and demand. And this is what we're looking for. It's that price has done a U-turn. It's not necessarily just price has done a U-turn. If we think about this now as a collective of traders, a group of traders was driving price one way. Buy, 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 buy. You know, if we imagine it in the old trading pits, you know, the pits are going crazy. It's buy, buy, buy. Then all of a sudden, that stops. There's no more buying, and prices aren't being driven high. Again, picture an auction where people are all bidding on a product. The buying stops. The price is being set. No one wants to buy at that price or higher. But in the stock market, what can also happen is that actually we don't want this anymore. Now what people are doing are starting to sell, 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 and price is being driven in the opposite direction. Nobody wants it. They, take it away from me. I don't want this anymore. Again, imagine, on the TV in the old trading pits. You would have seen it on, maybe several movies or in auctions. People are trying to get rid of the product now, and that drives the price lower, and it's this significant shift in supply and demand is what we're looking for. That tells me that the previous move might be over and a new movement might be about to start. And when we stack this at the end of all the things that we're doing, we're trying to find a statistical price extreme, the Bollinger Bands, to put a chart in front of us. We're categorizing the chart, the overall money flow movement over the last 12 months. What's price doing? Then we're checking to see if we're at a logical stopping point. Is price likely to stop here in the past? And then guess what? It does this. It does actually stop at the logical stopping point. And not only that, it gives us this dramatic indication to say, you know what, I'm not going any further. But not only that, I might start going in the other direction. And this is what turns it from a maybe trade into a today trade. So let's go and look at what that looks like on the chart. So I'm just going to circle some instances. Again, let's think about the location first. So let's go back to our categorization. As you can probably note, I've removed the Bollinger Bands off the chart just to make looking at this recording a little bit easier on the eye. Now we're looking for the spikes at the upper portion or the lower portion of the chart. Again, there's a few examples that aren't necessarily at the extreme lows, and I'm just going to ignore those because these are the ones that we're interested in. So what we can see is that when price is at the upper boundary or the lower boundary, when prices get here and the same thing is likely to continue to happen, quite often we get this indication to say, you know what, that previous move down has exhausted, and that's my indication to say, hey, it's exhausted. Then we get a strong rally up here, same thing's continuing to happen. That rally, that's likely exhausted, it's over, and it's at this upper boundary. Similarly, we get price moving down. It doesn't quite get to the lower boundary, but you can see that there is a little bit of a spike there. It's not quite at the best location. We might not have traded that in real time. But then price rallies higher. It rallies back to the upper boundary where it stopped previously. And guess what? We see a nice sign of exhaustion to say, you know what? That previous move is over. Now the next move might be to continue doing what it's already been doing, to move back to the lower boundary. That's our trading opportunity right there. But more importantly, that's our let's put the trade on today indication. It's not necessarily, well, it might turn at this location, we're at a good location, and you know, it could do something. This spike turns it from a maybe, and the indecisions that go along with that, yeah, well, maybe there's an opportunity, and it turns it into today is the opportunity. That's the big difference. That's what I'm looking for. Let's just zoom in a little bit so we can see what's going on. What we have here is a very clear indication that price has exhausted that downward movement, and you'll note that there is a very small body, but we've also equally got a very large wick. And again, usually I'm looking for a ratio of about 1/3 body and 2/3 spike. And you'll also note that this is at the extreme of the movements. We've got one here, but you know, it's inside that previous day. You'll notice that the candle that we're looking at, it's the lowest candle in the movements. So it's at the extreme of movements at a good location. That's what we're looking for. Next one, we're at the upper boundary. Again, we're looking for something with a big spike and a small body at a good location. We'll assume that we've done everything else so far. And again, what you'll note is that we have this, well, a minimum of 1/3 body and 2/3 spike. So we've got a very, very small body, and we have a very large spike on the wick of the candle. Now what you'll notice that's different from the previous one is as we were at the lower boundary, or we were buying the dip, we were looking to be bullish in our assumption, the spike was at the lower portion of the candle. Now that we've got the rally and we're at either a rally and a downtrend or we're at the upper portion of our consolidation, we can see that the spike is on the upper portion and the body is at the lower end of our day's range. So that's the way round that we want them. If price is at the in the retracement mode and it's moving lower and we're at support and we're looking to be bullish on the charts, then we want the spike on the lower portion, because again that tells us that price has sold off, but oh, it's done a U-turn and it's turned around, and that is our bullish indication to suggest that the previous move is over and that the next move might be about to start. Similarly, price rallies during that one day. This is how these spikes are created, and it's gone up to a logical stopping point, and not only has it stopped there, but the selling pressure has come into the day as well to create the spike. You know, it's done this intraday U-turn, and there's been a dramatic shift in supply and demand, and that creates the opportunity for me. We've got our statistical price extreme, we've got our categorization of the chart that price is range bound. We're at the upper end of the range in this particular case, and the next thing that's likely to happen is the same thing will continue to happen. And the spike is my indication to join the party, to jump on board. Sometimes we will see what we think are spikes. Again, we've got one here. that are not at a great location. Looking left, it's not at our logical stopping point. So while we can see these patterns develop at other locations than we would like, so we just need to be aware of that. We need the location first, then the spike. Similarly, we can get candles with spike and they're 50-50. So we've got half body, half spike. So 50% of the high-low range is body, 50% of the high-low range is spike. Again, just be aware of these candles. Again, they're not exactly perfect. Usually my experience with them is that price will drift sideways for a wee while. And we can see an example of that here. You know, it's half body, half spike. And what happened for several days is price just drifted sideways. So we just need to be aware of that. We're looking for the 2/3, 1/3 ratio. We need it at our preferable location, our logical stopping points. And we also need the spike at the extreme of the movement. So like this one over here, we've got our extreme movement, logical stopping points, and as we're at the boundary high of our consolidation, we've got the spike on the upper portion, and it might just suggest that the next move is lower. And as I'm recording this is a relatively new trade. I'm already in this personally. The alerts have gone out, the training has been done for the live training, and you know, it's moving lower. It's doing exactly what we thought it was going to do. The same thing is continuing to happen. And when we stack these odds, when we stack these opportunities on top of each other, Bollinger Band to scan to put the opportunity in front of us, categorize the chart, logical stopping point, sign of exhaustion. When we stack all these opportunities, it's really difficult not to put the trade on, because we've done everything within our power to find a consistent method to finding a successful trade. This process is a big part of why 68 to 72% of our trades are closed profitable. This is why it works. It's the selection process that we use, the logic, the methodology behind what we do. In everything that we do, it's this process of finding trades. Again, on average, approximately 70% of our trades are closed profitable because of this process. Don't underestimate the power of what we're doing. It's very simple in its application, but it's so powerful. So that's where we're at for the first scan. This is the process that we use to find, filter and sort stocks and trading opportunities, and this is what you'll be doing from now on.